Hi, I've been fortunate enough to be hired by some pretty smart people to manage their investment accounts. These are folks that have become very successful in their respective fields. Yet when it comes to managing their 401k choices, even though I am not the official advisor to their plan, I am their hired consultant and they come to me for guidance. When I asked these pretty smart people how they previously made their investment selections inside the plan, the answer most often was 5-year returns, of course. And I knew I should diversify, so I picked the 5 investments with the best 5-year returns. You already know that I'm going to suggest that that probably has not worked so well. But that is what had previously been made available to us. That is also why we developed this platform at BenAssured, to help plan participants go beyond returns and build portfolios with a real strategy in mind. Throughout the courses found on the BenAssured website, you'll be hearing some terms that will be new to most of you. They will include standard deviation, beta, Sharpe ratio, correlations, and many more. Most of these terms involve a measurement of risk. Why is risk so important, you may ask? Because the volatility of your returns will impact your results. Let me show you. Look at the attached chart with 3 example results. The green portfolio is up 10% in the first year and down 10% in the second year. The blue portfolio is up 20% in year 1 and down 20% in year 2, and the red portfolio is up 50% in year 1 and down 50% in year 2. They look like they all end up in the same place, and the average annual yield for each of those is 0, but their compound yields differ. If we start with $100 and gain 10%, we've gained $10 and have $110. If we then lose 10%, we'll lose $11 and end up with $99. If we have the same $100 and gain 20%, we'll gain $20 and have $120. But if we lose 20% of $120, we'll be losing $24 and we'll have $96 remaining. If we again start with the same $100 and gain 50%, we'll be happy with the $150 that we'd have. But if we lose 50% of $150, we lose $75 and have $75 remaining. Ironically, it doesn't matter if we have the gain or loss first. The results are the same. For example, if I have $100 and lose 50%, I'll have $50 left over. And if I gain 50% on the 50, then I'd have a $75 result. The same exact outcome results. My clients hear me refer to this as the investment roller coaster. I then ask them what they want their roller coaster to look like. The size of the variation of returns from the average return does matter to your outcome. The statistic that measures the average deviation from the average return is called standard deviation. If you look at the chart on the right, I have the standard deviation listed for the 3 outcomes. You'll see the outcomes are proportionate. The 20% return sequence has exactly double the standard deviation of the 10% return sequence. I actually consider the standard deviation in this example unusable. The reason being is that we calculated this using 2 inputs or 2 sets of data. If you were to look at a report on a mutual fund and saw the term standard deviation, most likely you'd be looking at a statistic that had 36 data points or 36 monthly returns over a 3-year period. Which piece of information would you deem likely to be more reliable? 36 monthly data points or 2? To take that one step farther, would a standard deviation using 36 monthly returns or a standard deviation using 120 monthly returns likely be more reliable? The longer the time period available to measure the risk, the better. If the roller coaster repeats itself in its up-down pattern, we get these results that you see on the screen. We'll see that the standard deviation is lower because we have more data and the data is becoming more useful or reliable. But we'll see that our net results are getting worse. The summary, if you repeat a bad thing, things just get worse. Now, one might think that if I change the return from an average return of 0 upwards to an average return of 10, like this chart where portfolio 1, or the green portfolio, is plus 20% in year 1 and 0% in year 2, for an average of 10%. The blue portfolio is plus 30% in year 1, minus 10% in year 2, also for a 10% average. And the red portfolio is plus 60% in year 1 and minus 40% in year 2, once more for a 10% average. One would think that the results would then start to favor the larger roller coaster. Or one step further, if the average of the 2 years was 20% positive, like this chart, then again, the thought might be that the results will start to favor the larger roller coaster. But they do not. Using 4 returns that average 10%, we'd have plus 20, 0, plus 20, and 0 again. Starting with $100, we'd wind up with $144 after the 4 years. Our average return is 10%, but the compound average return is 9.55%. Using another 4 returns that average 10%, but were plus 30, minus 10, plus 30, minus 10, starting with that $100, we'd have just shy of 137. That comes out to a compound return of just over 8%. And once again, using a bigger roller coaster that averaged the 10%, same 10%, but with bigger swings of plus 60 and minus 40 twice, we'd end up with $92 or a 2.68% compound annual loss on our investment, despite the 2 years of huge gains of 60%. We can move the average return to 20%, and the largest roller coaster finally has a positive outcome after 4 results. But time and again, the smaller roller coasters outperform in the end. So risk statistics should be a very important part of portfolio development. The charts and data shown can be downloaded by going to the web address shown on this slide. You'll notice on the chart a column entitled Standard Deviation, and the larger the roller coaster, the larger the resulting standard deviation. Standard deviation provides you with the expected deviation from the norm. In other words, the size of the roller coaster. In statistical terms, if we have an investment that showed an 8% annual return with a 6% standard deviation, that means that roughly 65% of the time we can expect the actual results to vary between plus 2% and plus 14%. That is plus or minus 1 standard deviation from the average. 95% of the time we can expect the results to be plus or minus 2 deviations, or between minus 4% and plus 20%. And 99% of the time, we can expect plus or minus 3 deviations, or minus 10% to plus 26%. Since I tend to get a lot of questions about this, I'll slow it down a little. As I mentioned, 99% of the time, the results will be between 3 deviations. I mentioned that the standard deviation was 6%, so 3 deviations would be 3 times the 6%, or 18%. My average return is 8%, so what I'm saying is that 99% of the time, the results will be between the 8% average minus 18, or the 8% average plus 18. So 99% of the time, the result will be between minus 10% and plus 26%. And approximately 1% of the time, the results will fall outside that window. So standard deviation is a statistic that clearly defines the volatility or roller coaster ride of the investment. Now, if you had all of your money in treasury bonds, those would be considered very safe. Even though our bonds were downgraded by S&P, they're still considered amongst the safest investments in all the world. But the long-term investment results are also very low when compared with other investment opportunities. So low that even after your positive earnings, you may have a loss of purchasing power, meaning that inflation may have outpaced your earnings and caused you to effectively have less. So if I were to suggest that you sell your treasuries and put all your money in investments in Russia, that would certainly have a higher standard deviation and would be more risky than your treasuries. In order to convince any logical person to do so, you would need a likelihood that you'll earn a greater return at least proportionately as large as the increase in risk. The trade-off is that the greater the return we seek, most often we need to accept a larger roller coaster or more risk in the process. In order to properly evaluate how one has done as an investor, you cannot look strictly at returns to make that evaluation. If I invest entirely in emerging market stocks in the last decade and earned an 11% annual return, I may think that I have done well, and I certainly would have done better than treasuries, but I may have been under-rewarded for the amount of risk taken. Each investor's risk tolerance, or the roller coaster ride one accepts to go on, is different, and also tends to change as the markets play with our emotions. But truly, risk needs to be considered in addition to reward. More on the idea of risk management can be found in the various classes on our website. I strongly encourage you to watch Understanding Diversification to get a better sense on how to manage risk, as well as correlations, the value of different, to gain an understanding of a valuable building block of portfolio development. One point I'll make before we go is that it is not accurate to evaluate the risk of each investment individually, but rather all of our blended investment choices as a whole. The Understanding Diversification class explains this in greater detail. In the meantime, it's important to realize that risk evaluation is every bit as important, and actually as important as 5-year returns. Please continue to join us through this educational journey, and hopefully we'll be helping you to build a successful 401k portfolio for yourself. Please go to www.benisher.com/participant for more information on the services we have made available to you. I'm David Schlossberg, and thank you for joining me today.